Good evening, everybody. Uneducated Economist here. So I was just reading a pretty good article coming out of Reuters talking about the excess cash in the system, and it's keeping the interest rates on the short term low. And it's a pretty good article, and I think probably it's best to explain it how it's going down by talking about the repo market from 2019, the September repo. Because what happened back then is that the big banks like the J.P. Morgan, Goldman Sachs, Citibank, all those guys, they have a reserve requirement that the Federal Reserve, basically establishes, and they say, okay, like, you guys have to have this certain amount of money every day at the end of the day. And some banks at the end of the day are in need of reserves and some have excess reserves. The ones who are in need of reserves borrow it from the ones who have the excess reserves. That interest rate is the interest on, or the overnight lending rate. That kind of establishes what interest rates are going to be like for the banks the next day. So like if you can imagine like a bank who needs this money in order to do business the next day, borrows it from them, they're not going to lend it out less than what they are borrowing it for. So if the interest rate starts to go up on that overnight lending, then the interest rates on all loans after that will start going up. And on that particular day, banks couldn't find any liquidity. There was no cash in the system to meet their reserve requirements. If they don't have the reserve requirements, they can't operate the next day. So they are in desperate need of getting this reserve requirement. They are willing to pay any price in order to get it so that they can operate. And that day it shot up to 10% in order to acquire this cash that they need. The Federal Reserve says, oh, no, you don't. We're stepping in and we are going to buy a bunch of those treasuries off of you on an overnight basis. So we're going to buy these treasuries, give you a bunch of cash. The next day, you're going to give us all that back, and we're going to give you the treasuries, and we're going to do it again, and we're going to keep a little bit of that cash as this goes, and we're going to make sure that you have plenty of cash in the system. Now, this was the repo market. It wasn't just on an overnight. It was like it went all the way out into months, and it was for tens of billions of dollars. I forget what it got up to, but it was quite a bit of cash that they were injecting into the system on an overnight basis to make sure that everybody had plenty of cash. What was going on there is that the government was doing a bunch of spending at the time, which was loading these banks up with treasuries. Now, these big banks, these primary dealers, they're pretty much required to buy these treasuries. That's why they're the primary dealers. And banks are pretty cool about holding treasuries because, they can hold treasuries or they can hold cash, and treasuries at least pay a little bit of an interest rate to them. So holding treasuries is okay. But they also need cash because cash is the collateral for getting loans. So, at some point, they need the cash and not the treasuries, and the banks were loaded on treasuries and not a whole lot of cash. Right then, a corporate tax payment came through, and it took that cash and it sent it over to the treasury. Where I think they probably went to the general treasury account or something like that. But it took it off of these big banks. And the big bank says, we don't have it. And that's when the Fed says, oh, yes, you do. Here's the repo. So that's basically what took place after that. They changed the way the banks kind of handled things, and they no longer had this limited reserve kind of thing going on, and they went to an abundant reserve basis, and now all of a sudden the banks had all the liquidity that they needed, all the cash, and the excess cash they would deposit back at the Federal Reserve, where they would get the interest on excess reserves. That's what's taking place on there. Now, what's going on is you got this inflation expectation. It's not inflation itself. It's not like, okay, we got plenty of money, somehow we got to get it into the system and somehow find this inflation. It's inflation expectation that the Federal Reserve is looking for, okay? The inflation is already here. It's the expansion of the money and debt. We already have the inflation. What we don't see it in is in the Fed's eyes. The Fed doesn't see that inflation from the way that they are looking at it. Now, I don't want to argue about whether or not we have inflation or don't have inflation. We've already gone over that one plenty of times. The inflation is already here. What the Fed is now looking for is that inflation expectation for the people to go like, oh my gosh, I need to react to this inflation scenario that is coming. I must do something with my money. And they are. And that's where you see the 10-year treasury start to rise. I mean, it was like 6 months ago, it was like a 0.5% yield on it, and now it's up over 1%. So the people are fearful. The investors are fearful of the future. And you think about it, you got this money, you can say, hey, what do I do with my cash? I can lend it to the government for 10 years, but this inflation thing is coming. I'm a little fearful of that. I think I want a higher interest rate for it, and that's what's taking place. So the longer term, you're seeing the interest rates, or the yields that the bonds have, rising, but on the short term, you see it dropping. Now, what's going on there is that there's an excess amount of cash, and these banks don't know where to go with this cash. Now, you think about it. If you have this excess amount of cash, it's like, man, I got to get rid of this thing. Here, I want to lend it to you. And the bank's like, no, I don't want it. I don't want your excess cash. I already got excess cash. And I'm like, well, I need to get rid of this stuff. I mean, it needs to get out there. And you go to the Federal Reserve and you start piling it up with them, and their interest on excess reserve starts to drop. So the more deposits that you have, the more that the bank has, and they don't need it, the lower the interest rates start to pay. If the bank needs it, the higher the interest rates go. So this excess cash that's now in the system is starting to drive down the interest rates on the lower end. At the same time, the inflation expectation is driving up the longer end. This is steepening out the yield curve. So that's what's taking place right now. Now, how long that'll last and what the cause and effects of it, who knows? There's easy access to cash, but the longer term inflation expectation is starting to rise. So there's kind of a couple of things that can go down there. I try to think about like that excess cash and what that could do as far as forcing irrational exuberance. China's already faced that, and they started tightening up. You notice China did it first. Like, China had the issue first, and they started having the problems with irrational exuberance, and the government had to do something about it. So they started tightening up their money policies, and all of a sudden now you got these corporate bond defaults taking place all over. Like, I think it was they're already up to like 33. We just did a talk about it, but it was something like 33% of what occurred in 2020 has already taken place in 2021 for Chinese bond defaults. That's incredible. I'll try and find that article. I'll leave a link to it down in the description. So you can see what happens when the government tries to mop up some of that excess liquidity. It immediately sends interest rates soaring through the roof, which are already starting to rise on the long term because of the inflation expectation that people have. I would keep a close eye on China. I think China is probably going to be like, what happens over there, I think is probably going to end up happening here in the United States. Because like I said, they started tightening up their money policy, and it already started causing all kinds of heartache amongst all these corporations and the corporate debt. That's what's going to take place here. I mean, we had a huge problem with corporations just feeding on this damn cheap interest rates. It's zombie corporations, it's zombie companies feeding on low interest rates. That's what's happening. All right, I think that's probably enough to talk about. All right, Uneducated Economist. You guys let me know.